Frank Holmes, CEO of U.S. Global Investors, is back. We're going to be talking about gold price action, the dollar, Fed, and airline stocks, and the economic recovery. Frank, it's so good to see you. Welcome back.
Happy timing now. We're in September.
That's right. Now, Frank, investors are getting worried that gold is not being able to breach the $2,000 level mark again. We're seeing strong resistance. What's going on with the recent price action, you think?
Digestion. It's going through the $2,000 level. The euphoria of Warren Buffett all of a sudden buying a gold stock. Just as a normal process. And going straight up is only going to lead to a powerful crash. So I love this sort of stair-stepping. It's a perfect market.
Okay. So you're not at all concerned about this volatility continuing. In fact, you think that you've told me before that you might want to be buying on the dips. Is that correct?
Yeah, that's right. And if you're not long, you'll be wrong. On every one of these big pullbacks and even shorter ones is understand the daily volatility of bullion. It's plus or minus 1% on a daily basis. If it falls 2% or more, 3% a day, that's when you want to be buying. If it surges 3% a day, that's the time you want to take some profits for those traders. And you can see this elasticity that it doesn't happen often that goes 3%, 2%. And that's what we're dealing with. Now, over 60 trading days, it was just normal after going up 2 standard deviations that we would get a correction of 10%. So I just feel it's actually going nicely sideways for me. Building, the companies are going to do phenomenally well. We're seeing this last quarter, the end of June. The numbers are excellent. High free cash flow, something that the Buffetts love, which we've talked about in this program for the past 6 months, to get ready for more free cash flow showing up in this industry. And I think come the end of this quarter, it'll even be more breathtaking when you compare to the overall S&P 500.
I think one of the things that spooked the gold market last week was when the Fed, during the Jackson Hole Symposium, announced that they would do whatever it takes to, well, I guess, prop up the economy, but also control inflation, suggesting that if inflation does come back, they would take measures to control it. That's a bit of a less dovish stance than what we're used to be hearing from Jerome Powell, and then gold kind of traded sideways after that. How would you be digesting his message?
That's just sentiment. Sentiment has a gamma. That news is good for 24 to 36 hours, and then it's gone. It's just sentiment, up and down volatility created by headlines. What's really important is the unprecedented growth in printed money all over the world. And now we're seeing it's $1.3 trillion of additional debate with Congress and Trump, what they're going to put into the economy. They're going to continue to print, and that's the reality we live in. So what Powell says, I'd rather take a look at the old algorithm, the old model for determining what CPI is. When gold hit $850 and silver $50 an ounce in 1980, that algorithm that defined what inflation was has morphed many times. And if we use that inflationary number to that model today, inflation is at 8%. What is he going to do to slow down inflation? Housing is up 10%. I can go on with a whole list of things that are much greater than this 1% inflation they're talking about. Why worry? Get long gold on corrections.
Now, Frank, I know you also like the equities, and the equities markets, as you know, has been, they have been improving steadily, slowly but steadily, keep rising up. The S&P 500 has breached all-time highs already. You see more upside, don't you?
I do. When you have zero interest rates, if you look at the CPI at 1%, allegedly 1%, it's a negative 10-year real. 5 years, even a greater negative return on your money. And a 2-year, it's terrible. You're going to lose 85% of that income it's just a negative rate of return. So when you look at stocks, like Newmont's and the Barracks, and I can go on. Now Grand Columbia is starting to pay a dividend, and other gold stocks, and Wheaton Precious. These dividends are higher than what you're getting on a 10-year government bond. So you want to be long those companies that have that capacity to pay dividends in a rising scenario.
So Frank, you did tell me before that you're expecting the balance sheet of the Federal Reserve to rise to potentially $10 trillion. Do you think that could still happen after Jerome Powell's message at the Jackson Hole Symposium?
Sure. He's got to show that he's a bit of a hawk going into that symposium because the dollar was on a slide. That was just his protocol. It's just sentiment news. Ignore that. Just really take a look at how much money is being printed by the EU and Japan and here and in China. It's just breathtaking. And I just think the concept of just using monetary policy to stimulate economic growth means each cycle requires trillions of dollars more.
I spoke to an investor, and he's just frustrated that the Federal Reserve is just continuously printing money. He's calling it borderline criminal. He's saying this is just blatant market manipulation, and he's just really angry. I mean, granted, he is long in the market, so he's making money on the equities, but he just doesn't like and support what the Federal Reserve is doing. Would you echo any of these sentiments?
I think it's much bigger than what he's saying. I think that what you're dealing with is a war, and the war is invisible. It's the COVID. It's the coronavirus, COVID-19. And you're seeing around the world this battle of fighting this, keeping people employed, keeping stability. So the cartel of the G20 finance ministers is very active and robust. And so it's like synchronized spending of money, synchronized printing of money to keep the global economy going. And therefore, hard assets, like saying real estate is booming, in addition to art is booming. Any dividend-paying stocks that have the capacity to increase their dividends, they're attracting bids. That's where money's going in a negative and zero interest rate environment. And I don't see that going away for a good time.
Okay. All right, let's move on to the economy now. We're here to talk about the potential recovery in our economy. You were just talking about COVID. Do you see any improvement at all in not just sentiment, but economic activity since last time we talked?
Yes, I see that there's the housing boom. And then take a look at Lowe's. Lowe's is now in an IBD 50, like we're seeing Kirkland Lake and Franco, Nevada, were showing up as growth stocks in the 50 biggest growth stocks by Investors Business Daily. You want to take a look at Home Depots of the world. There's a boom going on. Lumber prices are up. Copper prices. I write about Purchasing Manufacturers Index. It's up strong. It's above 50 and it's risen again in China. China consumes 53% of all the world's commodities and is highly correlated to the PMI. Now we're seeing iron ore prices up. I think you're right. This is a great time to buy on the dips.
The JETS ETF has risen substantially over the last month. Why do you think, just on a percentage basis, over the last couple of weeks, it's been beating the S&P 500 benchmark?
Sentiment. I think right now it's really sentiment. Any positive news in vaccine all of a sudden triggers a flurry in hotel stocks and the airlines. But what's more important is the TSA prints every day how many people they clear. And the more people they clear is a signal of growing revenue for the industry. And what we're very close to a breakout. And when that breakout happens, I think then the airlines take off for the next leg. That's not driven by sentiment of a vaccine, but more about actually people are flying more often. And I think it's going to happen after the long weekend.
Okay. So this chart that you showed me earlier, and I'll show the viewers this chart as well, is showing an uptick in airline activity. What do you make of that?
It's great for the economy. It's highly correlated to rising GDP per capita and GDP as a whole. We have to get business people flying more often. That's what the government's policies are. We have to make it safer for them. So we're seeing a big push and support for the airline industry. And I think we had the first big liftoff, and then corrected. Well, American Airlines, everyone did financings to improve their balance sheets. Now they're restructuring how many employees they have, what they need, and we'll get ready for the second leg. What's important for your listeners is that when we look at previous cycles, after 9/11, when all the airlines also shut down globally, it was only for a week, we turned around and we saw 6 months later up 80%. After SARS in Asia in 2003, the airlines industry as a whole surged 120%. And after 2009, they surged 80%. So I think we're still in that drawn-out process. I don't think we're going to get 6 months up 80%, but I do think over 12 months, we could get a similar rebound as the economies of the world come back together.
The CEO of Airbnb, Brian Chesky, has said earlier in the summer that he doesn't anticipate travel to ever return to pre-COVID norms. In fact, he sees less air travel and more travel by ground. How would you challenge that statement?
Well, I think it's a big job for the airlines to show how clean it is and how safe it is. I know my own personal experience flying Delta up to Utah. I mean, the plane was spotless, everything, extra precautions. I watched how they clean the airplane, they fog it out, they have sprays for alcohol to make sure it's just spotlessly clean, and there's much more discipline. I think as more people see those videos and read about that, then we'll get a more positive change of people feeling safe to fly.
And can you talk to us about how the JETS ETF picks airline companies? What are some of the factors you're looking for?
Well, it's a quant approach, and it has a two-part for A, picking the stocks, and then B, the portfolio construction. And the portfolio, the top four holders are the big U.S. airlines. Those four airlines basically fly close to 70% of all Americans. And so 40% of the portfolio is dedicated to United, Southwest, American, and Delta. The other parts are based on Air Canada would show up, based on their revenue growth, passenger miles, how many people are flying. There's a whole set of basically 5 key factors for the stock selection. And then we have airports, Bangkok, Beijing, in Mexico. These airports are public, so quite often they show up as private equity types of investments, and they've been populated and shown up in JETS ETF.
Now, Frank, I know that you're bullish on equities at large. I know that you're bullish on gold. If a new investor were to come into the space and he's looking for ways to allocate assets in his portfolio, what would you tell him? What should he be looking for, and what should he be focused on primarily right now?
When it comes to gold, I have always believed the 10% golden rule. 10% should be allocated to gold. And if you're going to be more cautious, then you're going to put 5% into bullion. You can use Kitco services for them. It's a great delivery system. And then you want to buy 5% into gold funds. I think it's important to look at people that have lots of experience in this space. So I do have an ETF listed in New York that delivers on that promise of looking at these gold stocks in a very sort of diligent way each quarter. There's other great gold fund managers. And if you're not you want to pick just a name, then I would stick with the royalty companies because they have the highest revenue per share. I mean, I would personally buy Franco-Nevada over Barrick. Now, I love the CEO of Barrick, but Franco-Nevada just has gross margins that look like it's a tech stock, have recurring revenue, have so much optionality to rising gold market and increasing their dividend. Their revenue per employee is like $24 million of revenue per employee, and Barrick's like $600,000. I just like that model. And they have the royalties on Barrick and Newmont's assets in Nevada. So if you want to buy an individual name as a safe way to play, it'd be a royalty company. Wheaton Precious, Franco-Nevada, Royal Gold. Those are the 3 big amigos that I really like. And then you have the Sandstorms. And then we have a rotation to look for those gold stocks that are showing the fastest revenue per share last quarter over 4 quarters and high free cash flow yield.
How do you think the election coming up will impact gold prices either way?
Well, I think that a lot of the rhetoric over what's been weaponized in America has been a slew of things. It's been Russia, it's been COVID-19, racism. We can list a whole bunch of things they create such a distortion in the overall capital markets. And I think it all ends after the election. But what won't end is all the money printing and all the policies that are in place for politicians to be reelected for next year and what they have to do for the next 4 years. So I think that debt load is going to be pervasive and everywhere. And I think the G20 countries are all working together on this money printing. And then this makes gold very attractive as an asset class.
Okay. Frank, thank you so much for coming on the show today. It's always a pleasure to speak to you. Thanks again.
Thank you. Happy investing.
Thank you very much for watching Kitco News. I'm David Lin. Stay tuned for more.